Hey everybody, it's P. Welcome to Stock Trading Pro. In today's episode, we're going to break down sector rotation for the entire week. And really the big question we're going to ask right now, have the bank earnings from last week finally broke the back of everybody who's had this big bearish Armageddon stock market crash headline theories right now, where look, the economic numbers might be pointing to that in the future. But I think one of the biggest things, and probably one of the most important things for the current stock market right now, is stop predicting where things are going to go sometime in the future and start paying attention to what they're doing right now. Order flow stacking and tape reading right now are keeping us on the right side, smoothly moving us from one sector into the other, and quite frankly, finding some pretty obvious and easy ideas. The biggest challenge that traders have had, I think, over probably March into April has been staying away from when the market kind of gets a little bit choppy and volume drops down a little bit. We've had this period of time where we've had these explosions and then kind of sideways and explosions and kind of sideways. And it's probably over trading during those moments in time where there's not much going on. And I actually want to give you an example of a stock right now. Maybe you haven't traded this, maybe you have, but it's actually Merck. We've been spending a lot of time when we review sector rotation and wondering whether or not which stocks are actually should be at the top of the list. And because sector rotation is one of the primary things that we do, we're basically looking to piggyback order flow. That's really the only way to put it. This is probably one of the best examples where you can start to see some of these really big energy candlesticks and then 3 days of nothing. It's really paying attention to those moments in time when there's less likelihood of follow through. And this is really important, and having a structure to tell you when it's obvious. I know that sounds obvious, but it's not. I'm actually going to talk about that right now because we actually have a question on our coaching call, which is actually 6 o'clock tonight, which is in relation to how do I stop the bleeding? How do I stop myself from losing money when the market kind of gets choppy and I'm not actually recognizing it in the moment? So we're actually going to cover that in a lot of detail. And then we have a bunch of stocks and sectors we're going to rotate for you today. One of the biggest things I want to get across, especially now, is this is my game plan heading into the week. This is the sector rotation and the list of stocks as of Monday. And I think one of the biggest challenges that a lot of people have in the stock market is they forget about that second set of decisions, or they don't plan for that second set of decisions. And what I mean by that is we have all this information, whether you're reading Investors Business Daily, like a lot of people do on the weekends, or however you end up getting your information, there's all that information again, leading up to making that decision. But then you have a whole nother set of decisions after you put the trade on, which could be position sizing, adding, initial profit targets, how you plan to handle your profits after they move in your favor. A lot of people don't have that kind of detail in what they plan to do. So we're going to get into that a little bit today too. But I think probably one of the biggest things that we're going to start out with today, which is the fact that volatility is not risk. And I'm going to break that down for you right now. Stick around. I'll be back in just 1 second. Okay, so what I want to do is I want to actually head on into our newsletter for today. We want to set the tone for the week based on what I believe, what I saw a lot of people miss last week. And this is based on comments and whatnot, where they did not take advantage of some of the bigger moves that were available and quite frankly, available for 2023 so far. For those of you that think that there's nothing to do right now and you're afraid of a bear market because the headlines have you kind of brainwashed at this point, there has been very obvious and, dare I say, easy sector rotation if you have a structure for finding it, which is actually what's going to tie us into what I'm going to look at right now. And I want to share this with you because I think it's kind of interesting. Hey, Allison, good morning. How's it going? So what we want to do is we want to first start out with where we are. So if you haven't downloaded this yet, you can actually grab a copy of this in the description below the video. So we have earnings spotlight here, but that's not really what I want to focus on. So you can actually take a look. Seeking Alpha gave us this list here. I want to start out here. And it's simply the fact that volatility is not risk. And I want to break this down for you. Today's topic is easily one of the biggest trading mistakes holding you back from seeing your account move higher month after month. Once you understand this aspect of trading, everything changes and it's about risk. Okay, I want to actually put this in here. Now, I completely understand a lot of people think risk is how fast a stock moves. And let me ask you, let's just kind of like reverse this a little bit and talk about trading from a risk perspective, how do you define risk? How do you define risk prior to putting a trade on? Now, when you start to get up to higher levels of distinctions, when you start to have a lot more trading experience, you define risk as the probability of something happening more often than not. So in other words, what are the odds of that happening? Now, the mistake that a lot of people make is they define risk as how fast something is moving. And they immediately say that stock is riskier because of how fast it moves. But let me ask you a different question. How much risk is in that volatility if the direction is clearly obvious and it's continuing to move in that direction? Now, again, everything we say is for educational purposes, but for the point that I want to make here is the higher the probability of something happening, by the very definition, means you are lowering risk because the probability is higher. Again, this is a high-level conversation. Everything we talk about here is for education, but I want you to really think about that when you're choosing which stocks to trade. Are you trading stocks that simply don't move that much because you feel like you've lowered your risk? Or are you trading stocks where you have a structure, which obviously our structure is the New York method, which is order flow and tape reading? Do you have a structure to tell you right now it's really obvious and there's a high probability of it continuing, and putting all those pieces together? So I want to finish this because I want my goal for this is starting your week out thinking properly, starting your week out with more earnings coming out this week, and stocks could be a little bit more volatile, but that doesn't necessarily mean that they are riskier. And we got that in JP Morgan on Friday. If we could take a quick look at JP Morgan, where the earnings on JP Morgan exceeded, and we had this giant bullish gap. And a lot of people are like, oh, it's gapped too far, I'm not going to be able to take advantage of that. But the stock followed through. And if you're a regular viewer of the channel, you know that one of the things that we do with earnings is we spend a lot of time with earnings. You can trade it into earnings and maybe forecast or predict or whatever language you're okay with. But let's face it, the odds of those trades following through on a consistent basis with upgrades, downgrades, beating guidance, lowered guidance, all of those kind of things. We beat the numbers. We didn't beat the numbers. What percentage did we beat the numbers? The way that we do things is I feel personally, it's just a little bit easier to let the number come out and then see if the person or institutional attention on that stock gets follow through. It's just a much easier way to do it. So the bank stocks last week, Citigroup, JP Morgan, had this massive rally. We also have credit services, Visa and MasterCard, having massive rallies right now. Visa and MasterCard right up near breakout levels as well, kind of lifting things. So we kind of shifted out of where for the end of last year, we had industrial stocks for basically 4 months. Heading into this year, we had technology stocks and even more specifically semiconductor stocks. About a month ago, we had the whole thing with SVB and FRC, those regional banks that kind of put a world of hurt on the market for that very short period of time. But now the big boys, the big banks have kind of like stepped up and said, look, we're not one of those small regional banks. We have tremendous balance sheets, and the earnings were pretty darn good. So now the question now is, are we rotating out of semiconductor stocks, out of technology stocks, even out of some of the stocks like communication services? Even though Meta is way up there right now, we're going to take a look at 3 of those stocks today. Are we now finally seeing a shift where maybe, just maybe, the Fed starts to not raise as much and, dare I say, slow down, if not stop? I don't think they're going to cut, but I do believe that in the way I'm looking at things, I do believe that they're going to slow down, if not stop, and see what happens. Inflation's still up to where they don't want it to be, but we're going to see. If that happens and financial stocks, and we start to get the energy stocks that we've been watching and the healthcare stocks, I just mentioned 3 different sectors that have been pretty obvious, especially for March and April. Again, rolling into where it's going now. Write this down. What's going on now? Not where do I think it's going to be a month from now? Where do I think it's going to be six weeks from now? There's enough good information that we can have by stacking the order flow, reading the headlines, reading the earnings to put together an argument of this is what's happening right now. And the probability of right now continuing is really where the real risk in the trade is. The quality of the idea and the odds of it following through, that's the real skill in trading. And I want to break this down a little bit, and then we're going to get into a big list of ideas for this week. Okay. So again, this is the newsletter that I put out for the community every Monday. You're getting kind of behind the scenes. So once you understand this aspect of trading, everything changes. Inexperienced traders mistakenly believe that risk is all about volatility. It's not. Risk is not simply about how fast or how much a stock moves. Risk is a measure of the probability of profit. Again, think about this. How risky is something if there's a good chance something is going to happen, all right? Volatility is simply the speed of that probability. Write that down. And the mistake traders make is believing that risk and volatility are the same thing. The critical error leads to incorrect position sizing. So now let's talk about that for just a second. Properly measuring probability, having a structure, that's all it comes down to, and having the right position size for directional volatility makes all the difference in the world. So what we're talking about right now is stopping the bleeding if your account's not going in the right direction, and then understanding the flip side of that is understanding how and when to make more. So these two things kind of converge to start to have you closer to net profitability faster than you probably ever thought, because when you're losing less by staying away from trades that have lower probability, and then understanding to spot better ideas and having the right position size. Every deal is not the same. You as a trader have to recognize how much warranted positions should I put into this. So in other words, how much position size should I be allocating based on the quality of that idea? You have to write this down. You have to put it on a Post-it pad. Every trade is not the same. What's the right position size? What's the right outlook for that trade? If it pushes and pauses, should I be getting out because the market's kind of choppy and sideways? Or if it pushes and pauses and everything's in sync, including something we're going to talk about right now in options, where the VIX is all the way down below 20, below 19, even getting down to 18. Those are bullish swing trade criteria. So you need to recognize these in the moment. And I want to really break this down, and then we're going to get into the sector rotation and the big picks, because the mindset and how you're approaching everything matters just as much, if not more, than the actual setups and which stocks we're trading. And let's face it, all of us can have the same exact stock and the same exact entry, but we can end up having 500 different exits because we didn't plan how we plan to manage that trade. Okay, so I want to keep going down, and we're going to go straight into the ideas. Okay, so this is really the big part here. And the mistake traders make is believing that risk and volatility are the same thing. And this is the big part here: incorrect position sizing. So think about this. How much do you think about what's the correct position size based on the probability? Think about this. Really think about this through. The higher the probability should have more allocated to the idea. It's just smart and, quite frankly, common sense. This topic has multiple implications, but today we're going to tackle the most actionable. Again, Monday into the week, we want to talk about what we can use immediately. The first and most exciting, when we have directional volatility, like we just showed you in Merck there for about a week or so, it's critical that you recognize this and earn more. You simply can't make reasonable profits when the situation offers everything you could possibly want. I just want to tie this back in. We actually had somebody last week, Don Maxwell, in our community. Don, I love you, man. You are one of our most passionate people. He had this trade where the way that we map out trades, we have our entry, we have our initial risk, and then we have our initial profit target. And our initial profit target is what we believe is likely for accepting that risk. And we're talking about swing trading right now. But as a part of that, we also have a piece in the middle of that, which is when do we plan to add shares to that trade? And Don actually had a trade, I believe it was Oracle, if I'm not mistaken. We'll take a look at that chart, where he put on the entry, it moved up in his favor, and he said, should I be adding here? And we kind of broke the trade down. We're like, well, it's doing exactly what you wanted to. The sector's strong, the group is strong, it's breaking out, volume is good. If not, when it's perfect, when would you add to a good idea? So you have to start to develop the habit of, well, it's right in front of me, I have to put the trade on. And it was a really good long conversation, but it's the flawless execution that matters more on a trade-by-trade basis. Over time, we'll look at the results over a larger sample size. So I want to keep bringing, you might want to watch this more than once. And if you're new to the channel, please do me a favor, hit that thumbs up if we're giving you some value, and make sure you hit that subscribe button. So I want to keep moving along, okay? So risk in this case is quote-unquote lower because the edge is strong, obvious, and if your timing is good, excellent reward potential. That's a big part there too. You could have the best idea in the world. If your timing is off, you're not going to have that same risk reward. In situations like this, the right play is to trade bigger or hold winners longer if you're good both. Again, this is a lot of, you want to download a copy of this for yourself. You want to go over here to File. You can either make a copy or File, download, and download it as whatever format you want. Okay. This is when unreasonable profits become the goal because volatility and your edge are in sync. So when probability is strong, risk becomes reasonable despite volatility. And I know there's a lot of people out there that might be saying, well, risk is risk, right? Volatile is risk. No, you can actually adjust the same dollar amount that you plan to risk on the trade by making sure you have the right share size. So in other words, if you want to risk $500 on a trade and the stop loss is $1, that's 500 shares. But if you want to risk $500 for a stock that's more volatile and the stop loss is $2, so double the stop loss, then you'd add half the share size to risk that same $500 for the initial part of the trade. So again, getting back to what we just talked about with Don, understanding when to add is a whole other part of the discussion. So remember, volatility and risk, completely different, okay? All right, so we want to keep working our way down before we get into these other topics here. So when probability is strong, risk becomes reasonable. I'm going to underline that, despite the volatility. Generating smaller gains in this moment is a big mistake, all right? And can only be solved by ruthlessly reviewing your P&L relative to market conditions. So this is another big thing right here. I know a lot of people get frustrated in their trading and they feel like, I should have done better. But what you have to do, and it's really critical, especially for your psychology and your mindset, you might have a little bit of a string of trading where maybe you're unprofitable or just not doing well, right? You always have to compare that to what kind of market conditions did you have? Did you underperform in your mind in a really good market condition? Or was the market condition a choppy mess and you managed the downside because you recognized it? If the market was a choppy mess, maybe you made or lost a little bit, maybe even lost a little bit, but if you managed position size properly and you recognized that probability was lower, even if you lost a little bit in that tough condition, that means you paid attention and that was actually good trading. The other side of that is when the market conditions are absolutely fantastic, it's imperative that you recognize it in the moment and make sure that you make a little bit more. And what we just talked about is we said that could mean two things: bigger position size or holding longer. If you're really good, you do both. Okay, we want to keep getting into this before we start to break down the rest of the stock picks. All right, so moving along to what I call the silent killer of trading accounts that hardly anybody talks about. Low probability trades. All right, this is really the part of the market that really drains our confidence. They're often masked by our ego in the form of lower share size. We make ourselves believe that lower share size makes lower risk. So again, come on, raise your hand. We've all done it, right? You can't tell me that you haven't taken a trade that was maybe mediocre, maybe even a bad idea. Maybe you're picking a top, maybe you're picking a bottom, maybe you're getting involved in the middle of nowhere. And you're like, you know what? I'll just put this trade on because I'm going to lower my share size and that makes it okay. No, it doesn't. A bad idea is still a bad idea. Lowering your share size does not make it a good idea. It makes it a position that you just simply have less share size on. Write that down. It's a lesson that took me years to learn. All right. All right. So we tell ourselves that lower share size means lower risk. Such a huge mistake. We make trade after trade with smaller position size, justifying in our mind lower risk because of lower share size. We convince ourselves that we're managing the downside. We're not managing the downside. It's still a bad idea. We got to remember that because we're actually throwing money away dollar by dollar. The small losses add up. And while our conviction moves lower and lower, we're actually losing confidence on all of these small trades because we believe we should have made money simply because we put the trade on, but we shouldn't believe that in the first place because it wasn't a good idea. Lower share size on a bad idea is still a bad idea. Remember that. And then the search for more or different indicators takes over our weekends. Raise your hand if you've done that, where you're like, oh, I'm not trading good. I need a different indicator. I need a different software. I need another monitor. That's not the answer. In our community, we call these moments of price action where money goes to die. Light volume, directionless, and board trading is a huge one, are the enemies of profitable trading. And look, they talk about this in all the trading books, Reminiscence of a Stock Operator, all of those books, right? I just want to keep bringing it to the forefront. The problem for many is we recognize it too late. Looking at your trading account hurts and your confidence gets shaken and you ponder how to stop it. You ask yourself, how can I prevent these losses? How can I stop myself from throwing money away? At the highest levels, you spot it before it happens. That's really where you want to aspire to get to. It's critical. And one of the things that we do in the audio broadcast that we have that we do every single morning is I am literally saying out loud what's going through my head so that the members of the community can recognize what I'm talking about. Some conditions, I'm telling them the market internals are not clear. Sector rotation is showing what we call a bunch of melted candles, which means that there isn't a dominant side of the market. But then we work all the way up and we're like, well, maybe we can find a few ideas, but the big picture is not on our side. So we're basically setting the trade expectation, and then that trade expectation plays into what is the right initial share size for that particular moment. You want to write this down. Recognizing it in the moment is what separates those who massively succeed in trading from those that are constantly looking for something different. You probably know enough about looking at charts, but you need to step up and realize that chart reading is not trading. Chart reading is looking for patterns. Trading is looking for money. There's a very, very big difference. Not only the money that we want to make, but the money that's allocated to create those charts in the first place. That's what we call order flow stacking. We are essentially stacking the order flow from 1 hour, 1 day, 1 week, 1 month, and then we're combining that with reading the tape and also perfect timing on our entries. So again, if this is new to you, you probably want to maybe watch this again and pause it and take some notes. And if you have any questions, leave those comments below the video as well. I'll be more than happy to get back to you. Okay. For those new or unable to stop it, after watching your account go south, you eventually admit these low probability trades are the reason you're not getting paid. That is a monster part of that. When you finally admit it, that's a big thing in trading. All right. Learning to spot better opportunities is insanely obvious, but are you actually doing it? And more to the point, are you not trading when probability is low? So again, I just want to wrap this part up in a really big way. Hey, Lynn, good morning. Are you actually paying attention and stopping yourself when the probabilities are low, or are you trying to justify it by simply lowering your share size on what are perceived as bad ideas? When you start to do that, you instantly change your trading account. You now stop losing on those trades you shouldn't be in the first place. And then you start to have your confidence rocketing higher because you're losing less. And now you start to pay attention to the situations when you should have a little bit more. Getting back to what we said, maybe a little bit more, or maybe holding a little bit longer. Best case scenario, you can put those pieces together and understand when you do both of those, bigger size and hold longer. Okay. Hey, Joseph, how are you? Good to see you here today. So let's continue. We want to bring this into options. Okay. So John Napolitano, if you want to learn about John, you can actually click here. Talking about the choppy markets. However, one of the biggest things, and you could read this when you click over here, John talks about this, which is something that is kind of a long-term thing in the markets, is good news was finally celebrated and bad news was sold. So the market's kind of normalizing now, which means that we don't have that big hangover in the beginning right now. So when in the beginning of a tightening phase, we also see good news be bad news, only for it to turn into even worse news. So we're not in that right now. Now, this is the big thing that we want to talk about here with the VIX. The VIX below 20, and I want to give you some context on this right now, the VIX, the volatility index, and we're going to take a look at the weekly charts. Now, here's the thing. So everything we've talked about here today is all about probability, right? What are the market conditions where the probability of buying a stock is going to continue in that direction? Now, we have some certain situations where, again, you're putting the pieces together like, and that's a part of the argument, and that's a part of the argument. And the more of these pieces you can put into the argument, the more conviction you should have for follow through in your direction. One of the most important things, and quite frankly, simple things, is to go back into history and say, when did stocks follow through in a bullish manner in the most consistent way that had directional volume and volatility? And we don't have to go back that far. 2021, we had this raging bull market. Yes, it was fueled by quantitative easing. We can all agree with that, right? However, there are market conditions and market internals that validate. They're kind of secondary indicators that say, okay, this is what I see in the price action. This is what I see in the volume. Here's the market. Here's the sectors. Here's the groups. And here's the stocks, right? But then you have other indicators. Could be advanced decline line. It could be the VIX. It could be whatever you happen to use, right? Market profile. I know a lot of people use market profile. Let's take a look at the VIX. And I really want you to start to say, wow, why haven't I taken advantage of this? I want to show you this. It's going to take 2 seconds. All right. So we can see where the VIX is now, and this is the $20 line. You can see support could not get under. Now, for most of 2023, the VIX is below 20, and even right now it's below 18. So let's zoom back over here at 2021 and look where the VIX was. The VIX basically spent most of 2021 below this level, and think about how your trading was in 2021. The bullish move that we had looked like this. It's pretty interesting. And now we're kind of floating near the high of this big breakout level while the VIX remains not only below 20, not only below 19, not only below 18, but it's 17 and change right now. Now, these are the conditions. Remember about 10 minutes ago, we said there's two sets of conditions. There's the conditions and all the information that we have to build that argument up to the point where we decide to buy a stock and get involved. That's what we just talked about. All the conditions that are unfolding right now in this moment. And that's a situation where we say, okay, as long as this is still valid, we're going to still have that conviction. The only thing that has to be fine-tuned is near the optimal entry. So in other words, if I buy right now, is there still enough reward potential based on what the stock normally does? And we do that for both day trading and swing trading. They have completely different criteria, but it's a kind of a cool way to say it. If I buy right now, if this stock normally moves $20 and it's already moved 18, why in the world would I buy this, even if it's obvious? But if it normally moves 20 and it just turned around yesterday and it's also got bullish order flow, then you might have some pretty good timing on that situation. So as we look at the way the VIX is lining up right now and combining that with what the market's doing right at this moment, we're kind of looking okay, right? So if we continue to break this down, and again, John breaks down what this means in the VIX here in a lot of detail. Again, you can download this in the description below this video. I want to work on now over to sector rotation. And again, if you kind of go back to what we just talked about in the VIX and the way the VIX looks over this period of time, you can see these are, excuse me, let me put that on a weekly chart. These are the weeks, right? The last 3 weeks of the VIX, actually the last 4 weeks, the VIX has been going down in a pretty big way. So if you're not familiar with a very quick overview of how you can use the VIX, when the VIX is going down, options premium is not anticipating volatility, fearful volatility. So they're kind of contracting. The lower the VIX goes, the less fear there is in the market. And that generally means the market's going to continue heading in that direction. So one of the things we talk about in our community pretty much every day is the VIX down below 20, the VIX down below 19. And as of this moment, it's down below 18. There's not a lot of fear in the market, and they're not pricing that fear into options premiums. Again, as of this moment, that could change by Friday. Who knows? But that's the information we have right now. So when you see that and the way the market's trading, it's very important to put this in sync with this. So if you combine just simply what we just talked about, even using secondary indicators to amplify your conviction in the probability. Now again, probability is likely to happen over a large sample size. It doesn't mean every trade's going to make money. But when you combine what we just talked about with the VIX falling for the last week, validating what we're talking about, you combine with the way the market has looked and sector rotation has looked over the last 4 weeks, you start to have some market conditions where you say, you know what, I got to get in here and mix it up because everything I could possibly be looking for is valid right now. Now, a lot of people are like, well, I'm afraid it's going to turn around. Of course, at some point it's going to turn. I mean, that's just the nature of the market, right? The trend is your friend until the end when it bends. That's just normal market action. It kind of does this, right? But that's nothing to be afraid of. That's something to plan for. And the way that we look at things, we say order flow is the institutional attention that's moving a stock up, right? There's attention. Somebody has research on it. A hedge fund did research, or maybe a bunch of hedge funds, and algorithms kick in and they're all buying that stock. At some point, that condition might change. The reason for buying might have changed. That's not the problem. I can tell you that's likely to happen at some point, right? All stocks do that. The problem is you're not prepared if it happens. So you're afraid to take the next trade. What you're really afraid of is you don't trust yourself to take the right action if that happens. If you have structure and you trust yourself, there's never a reason to be afraid. The only reason to be afraid is you don't trust yourself to say, if this happens, I'm hitting the road and then I'm going to go look for another opportunity. So remember that. Not only is the quality of the idea the real risk, but then there's that added part of that is, do you have the flawless discipline to say, if what I expected to have happen did, but now it's different, do you trust yourself to say, I'm done and I'm now going to go look for another idea? So the kind of ideas that we're talking about right now, you can see from 1 week to the next, outstanding week, pretty good week, sector specific week. These are the kind of things that, obviously, this is what I do for our community behind the scenes. I'm giving everybody kind of a sneak peek at what we do here to really give you some ways to think about where are you potentially underperforming in your trading right now, and how could you make some simple changes where you say, I'm just going to go where it's obvious, and until it changes, I'm going to continue to trade in that direction. So the way that we break this down, not only from a bigger picture in sector rotation, then we work through which sectors are performing over a certain period of time. And then we take a little bit of a deeper dive. We talked about Visa and MasterCard there before. Those are two big ones. And we take a look and see which stocks, as Visa right at a breakout level, something to keep an eye on today, which stocks then meet the criteria for us to then pull up those stocks and start to look for optimal entries. And you can see we're actually breaking this down. Gold and copper stocks last week were on fire. They're actually up at resistance levels right now. We probably want to let them pause a little bit. Home builders and hotels showing some pretty good price action right now. One of the interesting ones also, CarMax. CarMax actually had a pretty big breakout after earnings, and it's still holding the daily 50-period moving average as support. You can see here it held it here. This was some news, and I could actually see it's holding here again. So again, this is where we start to break it down. How much order flow is stacked? What was the reason for the rally? Are there any bullish gaps that I should be leaning on? What does volume look like during this pause? What is the likely profit potential? These small pieces that take us a couple of seconds go into how much we want to put into the idea. So again, if we go all the way back to the beginning of today's conversation, it's all about where is the money flowing now and whether or not we've identified some good optimal entries. Okay, so this is all broken down for you. You can actually see what the idea of the breakdown is. The one thing I want to talk about here is this. Something interesting to note. And actually, you know what? I want to stick here with the solar stocks. I want to talk about ENPH and FSLR for just 1 second, because this is kind of tying into the main point that we're making right now. Good morning, Robert. How are you? FSLR clearly has had some good bullish price action, almost going back a year. You can see this accumulation phase that led up to this big move. ENPH is kind of on the other side of the market right now. However, we are actually starting to see both of these stocks showing some price action. You can actually see here during this pause, we actually have a little bit heavier volume. This is the average volume. You can see how many times we're exceeding the average volume here, which is kind of tying me into this right here. Okay. So accumulation happens after a prolonged downtrend with heavy volume pause that can last for weeks. The churning during this type of price action often leads to a reversal. So that's kind of what we're talking about right now. In the case of ENPH, that means from bearish to bullish. Now, here's the most important thing. Right here. Something interesting to note is it's important that not only build a list of stocks you plan to trade today or this week, but also a list of stocks that are interesting. In our community, you'll hear me talk about this when we do our Saturday swing trade session, which is usually 10 o'clock on Saturday, or when I give the final list of stock picks that I do at night for everybody for the next day. There's always a list of stocks that I call other. And that other list are stocks that might not be perfect, but something interesting is going on in the form of price action and volume. Okay. Not necessarily near an optimal entry, not necessarily directional obvious yet, but too often we hear from traders who miss the big moves. Capturing consistent gains also comes down to preparation, not timing. We call this second list of stocks a tracking journal. So two things I want to get across here. Number one, we spent a lot of time today setting our mindset for the week. We also spent some time breaking down indicators, secondary indicators that have been pretty obvious for the last 4 weeks. Then I showed you how those indicators tied into the market and how those indicators validated what we were seeing in sector rotation, where that entire window I just showed you for the last 4 weeks was either green or neutral. No red on that screen at all for the last 4 weeks, based on how those sectors traded over that 5-day period. So what I'm trying to get across to you today is to rethink what risk means. Risk really means how good is your idea and how do you recognize that in the moment? So the reason I've given everybody the list of stocks that I'm starting this week out today, and that lesson on risk, and that image of the sector, and talking about that chart of the VIX, what it's done for the last 4 weeks, I'm hopefully getting you to realize, to rethink what you might think risk is. Risk really comes down to how many good distinctions can you put into that pot before you start to make a trade. And if you decide that you have a pretty good idea and your timing is correct, then it's really just a question of how much do I want to allocate that to that idea for my initial position. So what we want to get across here is in these ideas, both from an options perspective, from a sector perspective, and then breaking that all the way down into industry groups. I just want to point out some ideas that have order flow, have traded well recently, and then you could dive a little bit deeper and see how you would end up entering into those ideas. So again, this is Monday. We're trying to start to head in for the week. These lessons are timeless and stuff that we rely on every day. So if you're watching this at some point in the future, it's still okay. That lesson at the beginning about what risk really is can change everything for you. And especially when you get to the point where if risk is a high probability of following through, then the other side of that is you start to recognize, wow, this is not a great situation, but I might trade it anyway. You stop yourself, and now you're staying away from those ideas that actually have higher risk because they have really low probability. And lowering your share size doesn't change the fact that they have low probability. So I hope this lesson is really something that kind of opens your eyes up into the kind of market conditions we've had. If you took advantage of it, fantastic. You should be proud of yourself. If you found it a little bit challenging over the last 4 weeks and you did not recognize a lot of the things we just talked about, then watch this video once or twice, take some good notes, leave comments below, and I'd love to hear from you. And I promise I'll reply as soon as I can. All right. Have an awesome day, everybody. Thank you so much for joining me. Again, you can download this copy of the newsletter in the description below. And if we did a good job, do me a favor, give me a thumbs up and make sure you subscribe to the video. Have a good day now. Take care.